Welcome back. If you are listening to this episode and not watching on YouTube, I highly suggest heading over to the YouTube channel and checking today's video out. If you are on YouTube watching, it's going to be a good one. I got a special guest for you guys. Her name is Michelle Prather, and I've actually kind of built a little bit of a relationship with her over this past year. I've been learning a ton from her. She's actually the National VP of Sales for the Long-Term Care Department at one of our favorite companies that we utilize for our infinite banking style policies, and that's OneAmerica. So I decided to bring her on because she talks about something that nobody my age talks about. Not a single soul out there. But as I dig into this kind of wealth building phase of my life and make sure I'm in the position where I'm preparing myself and my family to the best of my abilities, that continues to involve all of my family around me. And so I started to think about, as my parents live with me, my wife and my son, who is going to be taking care of them when that time comes. They're in their mid 60s. Luckily, they're in great health right now, but we haven't really had that conversation. Well, we have now, but previously, before I had this knowledge, we hadn't really had that conversation around who was going to be taking care of them when that time came. Uh, when I lived back with my parents in high school and growing up, my grandfather actually ended up coming and living with us, my mom's dad, for a while because of some health related issues. He actually passed away in our home, but my mom was there taking care of him. We had some help come in that would take care of him. But again, a lot of kind of uneasiness around that conversation, especially with your parents, because we're talking about death. Just like with the life insurance thing, we talk about death. When it's infinite banking, it's more so about life. But when you start talking about long term care, you start talking about those things that people get a little bit uncomfortable with. So, Michelle is going to come in and she's going to talk to you about why this is so important, why it's extremely important, not only for folks who are getting up there in age, but younger folks like myself, and why you should actually kind of look at this in a different light outside of just, hey, long term care. This is boring. This is lame. This is not something I need to worry about because I'm super healthy. So I want to bring her on. She's going to do an awesome little overview and get you guys educated about why this should be on top of your priority list right now, no matter what age you are. So let me bring her in here. Michelle, welcome. So happy to have you and can't wait for you to share this information. It actually really excites me. I know it excites you too, but it really excites me to learn about this stuff because when I have all my ducks in a row, things really, I'm able to easily lay my head on my pillow at night and know that, hey, I'm taking care of everything that I can possibly take care of. So looking forward to pass this over to you and you just educating the people.
Awesome. Thank you, Shawn. Yes, so I've never thought long-term care income planning was lame. I know that might make me lame because I've been doing this for so long, but I absolutely love it. I enjoy it. And what we do saves families, and that is really important. And keeping the focus on making sure that we're providing everything that we possibly can, knowledge and options to people. Options give people freedom, and we all want the freedom to choose how we want this to look for ourselves. So thank you for allowing this platform, and thank you for advocating for those that you serve to make sure that they know that these options exist. So we'll go ahead and get started. And by the way, thank you for sharing your story about your family. What you just shared is not unlike a lot of people that we work with, people that have dealt with it, lived with it, took care of families, loved their families, and took care of them. But there's not without a cost. There is a cost associated, whether it be through someone's physical health, whether it be through their financial health, through their family life. It absolutely does impact them. So let's go ahead and get started with this. So what I'm going to do is I'm going to go through a couple of things. I want to call out what is long-term care, generally speaking, because a lot of people have misconceptions on what it is and what it isn't. So let me just make it really simple for you and your viewers. We'll go through some facts and figures, and hopefully I won't scare your audience too much, but we need to be aware of what we're talking about as far as costs and the trends that we're expecting to see. We're going to talk about the impact on families, the impact on finances, and then I'll give a couple of different scenarios for maybe some folks that are facing retirement, but then also, as you had mentioned, what I would call younger folks in this industry, those that might be in their 30s and 40s. So to show them some options that they might want to consider.
Awesome.
So what is long-term care? So first of all, it you might hear this called custodial care or extended health care. I call it long-term care because it just it kind of opens up the door because people think that long-term care is just a nursing home. And I'm here to tell you that long-term care income planning is a lot more than nursing home. It could be care for in your own home, which is where most of us prefer to be. I, took a long time to build up this stuff and get all this stuff. I'd like to stay with it. That's where I'm comfortable. It could also be informal caregiving where a family member, a friend might be providing that care. It could be an assisted living facility or even adult daycare, but it's more than just nursing home. And that's why we encourage pre-planning on this topic, because if you don't plan, then most likely your default option would be nursing home. And most people don't want that as their option if they can help it. But really, what we're talking about is things that we do every day. Shawn, you and I got up today. We got out of bed by ourselves. Hopefully, we were able to get ourselves cleaned up. We took a bath. We used the restroom. We fed ourselves breakfast. These are the things that we might take for granted because there may come a point at some point in the future where we need someone to help us do those things, and that's kind of hard for people to imagine that it's going to be them someday. Shawn, you're a big, strong, tough guy, right? It's hard for you to imagine that your tiny wife, whom I've met, she's fantastic, is she's going to be able to pick you up someday. Even now, she probably would have a difficult time picking you up. But imagine her being 80 and frail and doing that. And that's probably what you witnessed within your own family. So let me ask you a quick question. So when your grandfather's health was failing, who was the one that took care of him the most? Who was the one that would do the lifting and those types of things?
So oftentimes, again, if we didn't have a nurse coming in, somebody to actually be helping him with that stuff, it was my mom because it was her
Mhm.
dad. And again, my mom, very small woman, very, I wouldn't call her frail back then. She was a little bit, in better shape, but obviously, yeah, it's tough to be able to lift somebody off the ground after they've fallen, even if they're old and frail, because it's it's tough.
Yeah. Well, and most likely they're maybe trying to help you help them, but
Hmm.
oftentimes it's just dead body weight, and that's the hardest thing to pick up. So again, it does come with its cost, and we'll talk about that here in just a few moments. So long-term care, we're talking about it's not skilled care, and sometimes people think about that like in a hospital or in a nursing home where you've got the tubes and you've got the medication, all that good stuff. It's not that. It's the things that we would do on a daily basis that require someone else to help us do those things. Getting dressed, eating, and you can see those. We call these activities of daily life or ADLs. And you will hear about this, especially through your journey in planning for this. What are ADLs? Or you may have a severe cognitive impairment, such as Alzheimer's, Parkinson's, dementia, those types of illnesses. So here's the most updated national cost. So let me just say some areas are less, some areas are more. Again, this is just our national average. So we're going to go to informal caregiving. So this is the cost to have someone come in your home that might be a family or a friend or someone else that you might know, a neighbor that's coming in. And if you were to pay them, it's on average about $77,000 per year. A home health care aide, notice that there's an asterisk here. It shows $70,000 per year, but because that's based on a 40-hour work week. What we found, Shawn, is that once people are exceeding those 40 hours, that's when it gets really salty. And then we start to see people transition into a nursing facility to merely to save on cost. Assisted living facilities are about $65,000 per year. And nursing home costs, I believe that this is low. I've seen other ones for a semi-private room being about $100,000. But if you were privileged enough to have your own room, we're talking about the size of your bedroom here, it's about $120,000 per year on average. And here's the issue with this. That's just for 1 year. So Shawn, riddle me this. Let's say that you're doing well in your retirement years and you're living comfortably. Let's just use a nice round number of 200 grand, because you've got a while before you retire. So do I. So let's say it's 200 grand. But now suddenly I have a new bill that starts showing up, a new expense, and it's going to be an additional $100,000 a year. And by the way, it's not guaranteed for 1 year. We really don't know how long I may need care. So if I'm living on 200,000, that means my spouse needs that. And by the way, I don't know if you or your viewers have ever figured this out, but once you're in retirement, you're no longer saving for retirement. You usually spend every dime in retirement, whether that's for living expenses or it's traveling, whatever it may be. So those obligations don't go away. So we're talking about 200,000 and then I now need another 100,000. Where do I get that? Well, so I might start, pulling out of my portfolio. I might start crashing some plans that I had. Maybe I did have a banking strategy. Maybe I do have money in the bank. Maybe I have real estate that I'm going to have to start piecing off and selling because I got to get the money from somewhere. Here's the other thing, the ripple effect of not planning. The government now sees that, Shawn, you're not living on 200,000 anymore. You're living on 300,000. And guess what? They tax you accordingly. So they love seeing that people are pulling in more income because they get to tax income. So now you're in a higher tax bracket. Oh, and by the way, if you're over 65, Medicare premiums are based on your income. So now your Medicare premiums, as well as your healthy spouse, those have now increased. The ripple effect of not planning for this far exceeds whether or not you feel like you're wealthy, but it far exceeds that. Because I just did some back of the napkin math the other day. That a gentleman that I was speaking to, in order for him to get $100,000 out of his portfolio, he'd have to pull out $127,000 just to satisfy federal Medicare premiums and state and local taxes. That's not good math. I'm not going to pull out $1.27 to get the dollar I need. That doesn't make any sense.
No, it doesn't. Not at all.
So yeah, so here's the other issue. Again, this is not for 1 year, or this is not just for 1 year. Let's talk about the averages. So the average length of care for men is 2.2 years. For ladies, it's a little bit longer. It's 3.7 years on average. And then Alzheimer's right now has an average length of care of 8 years. 8 years. Now, I'm going to blow up these averages because if you or any of your viewers are going to do any kind of research, they're going to see this. This is published in articles everywhere, but they don't give a lot of context. So first of all, this is just care in a facility. There's really no way to account for people getting cared for at home by family or friends because we don't know when that started. So it could be and should be a lot longer than what we're seeing here. The other problem is this is just averages. And how do you get an average? So I like to use this little silly, picture. But if I'm standing in a bucket of ice water and my hair is on fire, on average, I'd be comfortable. Well, that doesn't make any sense. So what we're talking about when we show these numbers is what's going to be comfortable. Because let's look at Alzheimer's, for example. So if that's an average, that means 50% will need care for less than 8 years, but the other 50 will need it for longer than 8 years. That's a problem. So the issue is people tend to, when they do start planning, they want to plan for the averages, which I call planning for long-term care, because you don't know how long you're going to need it. The only way to ensure that you have enough money is to plan for it taking care of you however long you need it. Whether it's 2 months, 2 years, 20 years, you want to make sure that you have a source of income. Remember that additional $100,000 to kick in and pay that. You need that source of income to kick in and start paying the entire length of you needing care, or you and your spouse. Shawn, what do you think about those averages?
I mean, you better have some good money saved up because, that's a couple years, but you're talking about multiple 6 figures is what it could end up costing you. And then the scary thing is Alzheimer's and stuff, that's becoming so much more prevalent now.
Yes.
And like I've heard you say before, the body will keep going, but the mind is what fails. And that's what's going to keep you kind of racking up those bills, unfortunately. And gosh, I don't even know what you do when you get into that situation financially.
Well, most people end up spending down. We'll talk about that. Most people will end up spending down and end up on government aid, which I'm thankful that it's there. I
Mhm.
had grandparents that was, recipients of Medicaid, and I'm thankful for it. But we know a lot of people end up on that program that ought not be. And it was simply because they didn't have someone, a trusted advisor that said, hey, this is going to be an issue. But the good news is you have options as long as we plan now. The younger and healthier you are, the better these options get. So, okay, we'll move on. So there's some trends that we're watching, paying very close attention to, and these trends will and should have a huge impact on these future costs. So number one is just the high demand. So right now there are 10,000 people every day turning 79. That's the oldest of the baby boomer generation. And there's 20 years of boomers falling right behind them. But here's the problem. The bulk of the boomer generation, which is a very large generation, has not yet begun to need care. We're starting to see that, and we will, especially in the next 5 to 8 years, we're expecting. We're going to see high demand. We all know how supply and demand works. If there's high demand for something and not enough supply, then of course the cost can skyrocket. So we're talking about, will there be enough care providers and care facilities to take care of such a large generation? So this is a big issue that we're paying very close attention to. Number two is longer life expectancy. It's a good thing that we're living longer. It just requires us to plan differently. So, medical technology has done great things for our bodies, but they have not fixed our minds, as you talked about just a moment ago, Shawn. So, we are, I see less and less people smoking. I see more education about health. People, not eating Crisco anymore. I remember Crisco being a thing back in the day. We don't see that as much. We've got surgeries and medications that help us and has prolonged our life. So, I love to use this saying, the solution to one problem is the creation of a new problem. And if you think about it, that's what we're doing. We're solving one problem where death from heart disease, strokes, and cancer has decreased over the past decade, but Alzheimer's has increased 145% in the past decade. So we just have to plan for this. So Shawn, I often tease when someone tells me, when a client tells me, Michelle, I'm healthy, I don't need to do this. I tell them, you're the problem. So don't exercise, start smoking, drink, eat bacon. I'm kidding, of course. Some of that's okay, but we're living a healthier lifestyle, and therefore it requires us to change the way that we plan. So what did I hit you with the bacon thing? Because I'm a bacon, I like bacon.
I love bacon. I wish it was better for you because, oof, boy.
Oh, yeah. Why is it all the bad things, the good things that taste good are bad for you? So nonetheless, I
I really
digress.
like broccoli with
Another
butter.
trend that we're watching. I do like broccoli with butter. Back in the day, we used to pour the cheese on it. Yeah, it's probably not
Yeah,
good either. So,
kept making it
um,
worse. Better.
family dynamics. Kids are not sticking around to take care of mom and dad. Shawn, you are the enigma right now because most of the time we see people moving away. Maybe for job opportunities, they went off to college, met their sweetheart, they stayed. We have seen an outsourcing for mom and dad's care because there's two working parents in a lot of homes these days, or they just don't live close by. So this has changed as well. So more people are entering into assisted living and nursing home facilities because they don't have family and friends to take care of them. And then the last one, believe it or not, this is a trend. It is our government. And regardless of how you might feel politically, there's one thing we can all agree on. Government always changes. So what they have available today may or may not be available 10, 15, 20 years down the line. We just don't know what it's going to look like. But I can assure you it will be different. And mainly because Medicaid is mostly funded by the states, partially funded by the federal government. But the states can't print money. So they have to find it within the budget. That's the problem because the bulk of the budget in every state is Medicaid. So it's taking care of those that cannot afford to take care of themselves. So we are starting to see some states, there's 13 right now, one state that actually implemented a new tax specifically for this reason. So they got to come up with the money somewhere. I don't know about you, but cash is king. Is that your line? I probably stole it from you. Cash is king, since you're.
Oh gosh, no, I'm pretty sure Chris has used that before though.
Chris has used that. Okay, so cash is king.
That's for sure. Access to it.
It is because now you can purchase freedom. You can purchase choice. You can purchase dignity. So I would highly recommend government's there in the chaos situation, and I'm thankful for it. But if you plan ahead of time, then you have a lot more options available to you. So these four trends, the number of people, how long we're living, who's providing care, and who's paying for it, will and should have a huge impact on care. One more number. I know I'm probably killing your audience with all these numbers. You will see this as well. 70% 70% of our population will require care at some point in their future. But here's the problem: most people believe they are the 30%. Why do I say that? Why do I say that, Sean?
I'm healthy. It'll never happen to me. I don't need it.
It
It's not possible.
will never happen to me. That's what I hear so most. And I'll tell you why. Most people don't want it to happen to them. So they deflect by saying, nope, not going to happen to me. Nursing homes are full of people that said the exact same thing. So whether you want it to or not, sometimes it happens. And by the way, it's not 70%. It's either 0 or it's 100. It's either not going to happen to you or it's going to happen to you. But I've heard so many excuses, Shawn. I've heard, Michelle, everyone in my family dies young, therefore I will die young too. Well, maybe they smoked and ate Crisco and bacon. Yeah, I'm teasing, of course. Maybe there's a reason for it, but maybe you've lived a different lifestyle. I've heard, Michelle, I will shoot myself. This is a very popular answer when it comes to talking about long-term care or aging. And it's an unfortunate situation, but I will also tell you that same excuse, nursing homes are full of people that said that as well. My dad actually said that to me when I first started this conversation with him. And my response to him was, is that what you want my daughters to know that you did? And that really kind of pushed him back on his heels, because I called him out on, hey, that doesn't have to be the option. We can do other things. And then my favorite, after I asked him, and he said that, he would shoot himself. Then he said, well, if it happens, we'll pray about it. And I said, well, Dad, who do you think sent me here to tell you to, to plan for this, to do this? So he got mad at me nonetheless. He knows I'm a little smart aleck, but I would only push him back on that. But we know why people are deflecting, because it's uncomfortable. This is not a fun conversation to have, because people are most likely remembering their own family situation. They're probably remembering, my daughters, they're well in their 20s now, but at the time they were probably 3 and 4 when we would go and visit my grandfather at the nursing home. And they vividly remember there was a certain smell. They remember old people being parked in the hallway in their wheelchairs. They remember, especially with little kids, old people come and pinch them and touch them because they don't see little kids very often. They were so excited to see little kids, kind of freaked mine out. But nonetheless, they remember this and they go, no, not me. I'm not doing it. Rather than just putting a plan in place to have options. And one of those is not going to a nursing home. So regardless, we need to make sure that we're pushing through this uncomfortable conversation. They are hard conversations, Shawn, but it is imperative that we still have them, because it does impact families. So here's what I'm going to ask. There's 2 questions I'm going to leave your folks with today. The first one is, look, you may not need care. It may not be you. But if you did, how will it impact those that you love? And Shawn, when I say that, I'm sure you're starting to think about your wife and your boy. If something happens to you, what happens to them? Because it will be put on them if you don't have a plan in place. So let's talk about what happens. So first of all, Shawn, your wife, if you don't have a plan in place, she's going to do that. So she might have emotional impacts, because maybe she can't leave the house anymore because she can't leave you alone. Maybe she's mourning, a previous life where you guys used to be able to go on date nights and go out and you had freedom, and you were able to take care of yourself and really nurture your relationship. The physical challenges, as I said, even young and healthy, picking up someone, I don't care how old you are, is difficult. Moving them, bathing them, helping them get dressed. And this 24-hour taking care of someone is really tough. And then, of course, the financial impacts. If you do have the means to be able to pay for someone to come home, that's got to come from somewhere, right? So it might impact her retirement lifestyle. Next would be, what if she's maybe gone and you're on your own and you have an adult child that's going to care for you? How does that impact him and his spouse? Is that going to, maybe he's a career person. Maybe you have a daughter. Maybe she's a career person. She's a mother. She's married. If I'm spending all of my time taking care of my dad, that's going to impact my job, my spouse, and my own children. Something has to give. And usually I'm last on that list. So now my health starts to fail, which is not good. Adult sibling. Shawn, do you have brothers, sisters?
I do. I have an older sister who has a family. She lives out here as well. She's married. She's also a nurse. But yeah, I know where you're going with this. So go ahead, ask the question.
Yeah. So
Yeah.
what if she cannot take care because she's got a child, she's got a job, so she can't come over and take care of your parents. Do you think tension and resentment might pop up if those challenges aren't equally shared? Absolutely.
Naturally.
So oftentimes we see families start to break down here. There's a saying in my industry that death oftentimes brings families together, but someone needing care can rip them apart because there is not usually an equally divide of the responsibilities or the caregiving. Sometimes maybe the male child lives far away and he might send checks, and maybe it's an adult daughter that lives close by and she does all of the heavy lifting. Nonetheless, tension and resentment pop up. And then last, what if you aren't married? What if you never got married? What if you're a widower or widower? What if you never had children? What if your children live far away, or the kids that you do have are not good kids, they're turds, and they're just not going to help you? Like, what do you do? Who's going to advocate for you? So, again, and Shawn, this is where I would like for you to talk about how you see this maybe impacting your family. But the first question is, how will it impact those that you love? Have you thought about that?
Yeah, I mean, unfortunately, I am not 35 years old yet, so I cannot put a policy in place for myself. But as soon as I turn 35, this is something that is on our checklist because this is so important. And again, I know you've mentioned this when we've talked before, and you kind of gave me the example, but you had brought up the fact like, hey, things are happening to people who are a lot younger, a lot more often now. One of those
Mhm.
examples was cancer. We brought up the fact, and
Yes.
I actually asked you this question because I needed a little clarity about it, about the turning on and the turning off of the care, where it's like, hey, there's a
Mhm.
good chance, unfortunately, a pretty high chance that either my wife or myself gets cancer, fairly early in life. What do we do then? So we want to make sure we have policies specifically for that, but having access to something like this where she might have to leave her job to help me out with some things, I might have to stop working my job. What do we do then? Where is that gap going to get filled at? And it's with something like this that, again, I think you can turn on to start
Mhm.
utilizing, turn back off until you need later on. But that is at the forefront of my mind, especially with my parents starting to age, is like, hey,
Mm.
I want to be as helpful as I possibly can to them. But we've also had the conversation that I know that they don't want to, I don't want to use the word ruin, but
Mhm.
drastically change my or my sister's life and our family's lives because of having to spend a bunch of time taking care of them. That's not what they want.
Of course not. Any good parent would not want for their children to be burdened by them. My dad, it would crush my dad to know that he was the reason I didn't get to fulfill my dreams and my purpose on this earth because I had to sacrifice that in order to take it. Would crush him to know that. Any good parent should think that way, I would assume. And you're exactly right. So, what's happening to younger people? We just watched Bradley Cooper, the actor, Bradley Cooper, just directed, I think, a new documentary called Caregiving, and it is eye opening. It's on PBS. You can download the app and watch it straight from the app called Caregiving. But there was one of these stories where a male and female got married very young in their 30s. As a matter of fact, I think he said she was 35. Just had a child. The child was just a couple years old, and she had a stroke, and then she had another one. I think it was two. And she cannot do anything for herself. He had to quit his job because taking care of her and taking care of a baby, a young toddler was, and he's like, it's all the time. He goes out into his car, he screams, he cries. This is not the life that they were supposed to live, but he loves her and he's going to take care of her. And things happen. It's not just always someone else. It does happen, and we have to be prepared for those things. Thank you for sharing that, Shawn. So the second question, this one is straightforward. It's just going to hit you between the eyes. If care is needed, how will you pay for it? Because it's not cheap and it's not free. I just showed everybody that. So here's what we think about when this happens. First of all, is taxpayer assistance, and I already kind of went through that. There's a misconception that Medicare pays for this. Medicare does not pay for this. Medicare pays for nursing home for a very short period of time following a hospital stay, does designed to be rehabilitative, meaning I just had hip replacement. I have to rehabilitate so I can go back home and live a healthful life again. What we're talking about is I'm going to most likely need care from this point forward. I cannot get myself dressed or bathed or use a restroom without assistance from someone else, or I have a cognitive impairment. That would be Medicaid. And we just went through Medicaid is the most expensive plan because it costs everything, meaning you have to spend down your assets to a poverty type level in order to qualify for Medicaid. Your income and your assets have to be at a low level. So that's an issue for a lot of people. And again, we don't know what the future of that's going to look like. The second way that people know to pay for this is long-term care insurance. So I want you to think of like your car insurance or your homeowner's insurance or health insurance. If you make a premium payment and you are covered, if you have a legitimate claim, then they will pay it. Otherwise, there is nothing, there is no value there. When you pay for homeowners coverage for 30 years and you die, they don't give a check to your kids and go, yep, your mom and dad, they never used this. So here you go. Here's all your premiums back. That doesn't happen. There's no access to cash value. It's literally just a coverage. So a lot of people, remember, historically, Shawn, these people don't think they're going to need it. So why would I pay for something I don't think I'm ever going to need because I'm not going to get any value out of it? So they consider that to be more of a use it or lose it policy. I applaud anyone who has bought these because it's always appropriate to transfer risk to an insurance company, but nonetheless, we know a lot of people haven't. So that brings us to the third person. This is the person that ends up paying for it out of pocket. So that's either default because I knew nothing about it or I just didn't, or I do it by choice because I believe or I've been told I have plenty of money. I can just pay for this out of assets or income. There is a ripple effect to that. I talked about it a little bit earlier, but we're about to dive into it. So we're talking about income or assets. The problem with paying for this out of income is it's not a one-time payment. This is a new monthly bill. Let's just think about this logically. There's a new monthly bill that's going to show up every single month without an exact end date. I don't know how long this is going to last. So I don't stop paying all of those other obligations in order to pay this new bill. So that income has to come from somewhere. So now I have a cash flow problem. Or I could pay for it out of assets. Here's the problem with paying for it out of assets. You may end up liquidating faster than what you had intended. And that creates a whole nother issue. Maybe my spouse's retirement lifestyle is impacted. If I had planned to leave an inheritance to my children, I plan to do so. That's going to be impacted. I told you about maybe a higher withdrawal rate. I had planned on pulling out 4%, but now I have to pull out 8%. Well, that comes with its cost. Higher federal tax rate, higher state and local, higher Medicare premiums. There is a ripple effect to this. So, and here's the other thing is, can you time the market? Maybe you do have money in the market. Can you time the market with your illness? I would say probably not. So are you going to sell at an inopportune time? Are you going to sell off in a down market? It's hard to recover that way. So the real issue here is it's not an asset problem. It's an income or a cash flow problem. How much are my assets able to generate a new income at the exact moment I have to turn it on? That is the problem. So we have an income or a cash flow issue, and we would like it to be tax-free income, not taxable income. And so we'll talk about that. So here is what the government decided. And by the way, this is a long time ago. So the government came up with some tax incentives. And by the way, that's how the government controls our behavior, right? They use taxation. If they don't want us to do something, they raise taxes on it. If they do want us to do something, they lower taxes on it. It works really well. I don't know about you, Shawn, but I'm constantly looking for tax blessings, whether it's tax deferral, tax-free at death, or tax-free while I'm alive. And so that's what they said is, why are we waiting for people to spend down their assets to end up on a government program? Let's give people tax incentives to encourage them to plan now, not wait. And like I said, I love it. So this is Michelle's money. This is everything I own. I might have some moderate, some aggressive, or some conservative type assets. And if, Shawn, you asked me that question, Michelle, how will you pay for this? I'm probably going to identify money in my conservative portion because this is money I have quick access to. I don't have to sell off. I don't have to take a loss. Maybe it's my emergency money anyway. Maybe it's money at the bank. Maybe it's money in a life policy. Maybe it's just cash that I have available. So the government said, why don't you reposition that? We're going to give you tax blessings if you use certain policies for that. And so the policy that I'm going to talk about today is the use of life insurance. Now, Shawn, when I say life insurance, most people have learned life insurance in only one way. They understand it to be income replacement if I die and I still have young kids, or I can use life insurance if I still have a mortgage and it pays it off. What they fail to realize is that life insurance is one of the last buckets that are chock full of tax incentives that we all love. I've got tax deferral on my growth. Love that. Tax free at death to my family. They'll love that. But then the government has blessed it with one more tax blessing. I can use all of my death benefit while I'm alive, income tax free to pay for any kind of care. So whether that's nursing home, assisted living, home health care, now we can pay family members out of this. And I can use all of that death benefit. I don't have to wait until I die to benefit from this. My family and I can use this right now tax free. And by the way, it's a leveraging tool. It takes my pennies and makes them much bigger. We all want that. We'll talk about that in just a moment. But really, what I'm doing here is I'm turning this into a forever, never ending bucket of hair on fire. If you remember my analogy earlier, hair on fire, that I cannot outlive, nor my spouse. Now, this can be done for individuals, but it can also be done in spousal situations, domestic partners, civil unions. We can take care of two people on this policy. So, in essence, what I'm doing here, Shawn, is I'm carving out a piece of the pot to protect all of it. It's portfolio insurance. It's protecting all of my other plans so that they remain intact. And I know that you enjoy, banking strategies. I think it's fantastic. But if I don't have a plan, that just wrecked my banking strategy. All of that money has to be pulled out. So what's the point? I've just wrecked that. If you do generational planning, now you've wrecked it for your entire family. And you had a banking strategy put in place for a very specific reason. So this is the income and the cash flow designed to kick in so that everything else that I planned remains intact. So let me pause right there. Shawn, what do you think about that?
That's genius. Again, so I'm going through a very similar situation with my dad because my mom doesn't qualify. We have a whole life insurance policy that we built for infinite banking on him. And now we're trying to figure out, hey, if we add one of these type of long-term care policies and something happens to you first, we have
Mhm.
access to a long-term care policy to help cover those expenses. If something happens to my mother first, we have the cash that we've built up in your policy to act as that vehicle to kind of supplement for that. But this is so smart. And you guys, if you watch this channel, you know it's all about building wealth. And the richest people out there have found ways to take pennies and buy dollars with them. That's what the whole
Yeah.
thing is about. Buy low, sell high. That's exactly what you're doing here. This is portfolio insurance. This is asset protection. These are all of these extremely important things to save what you've actually built and to use someone else's money to do just that, to provide you with the income that you need. I remember you gave a story on Chris's podcast about the gentleman whose advisor was telling him that he doesn't need it. He was worth 25 plus $1 million or something. And you were saying that his advisor was telling him, hey, you don't need this. And he's like, no, no, no. I do need this because I want to spend their money, not my money. The whole point that I built this
Yeah.
thing is so I can make it last as long as possible. If I can buy dollars for pennies, I'm buying as many dollars as I can.
Yeah. And as a matter of fact, what he said exactly, because his words were powerful. The advisor became the student in the situation, and the client was the teacher. So the advisor kept telling him, "You don't need this," and the client says, "You're not hearing me. I didn't say I needed it. I said I wanted it. I don't want to use my money. I want to use your money to pay for this." Because that's something that wealthy people understand. Whether you're wealthy or you're not, we all want to know the secrets that they use, right? And they really focus on three things. They understand taxation and how to avoid it legally, hopefully, but they understand taxation, and that's one of the biggest expenses that they'll have. Number two, they understand leverage and how to get it. What is leverage? Leverage is taking your pennies, making them work like dollars, or using someone else's money. That's a big deal. And the third thing they do is they always give their money instruction. So they don't have one big pot of money that everything comes out of and it all behaves the same way. They have certain buckets that are designed for specific purposes and they behave a certain way. That's what wealthy people do. And they do it really, really well. They don't just win the lottery, right? These are people that make strategic decisions. And the first thing is always in a taxable situation. They always try to sniff out those tax advantages and those tax blessings. So thanks for sharing that story, Shawn.
Yeah,
All
for
right,
sure.
so let me give some examples. So let me show you some numbers. So the first one I'm going to show you, oh, the screen's not moving here. The first one I'm going to show you is, so actually, I'm going to show you how this works first, and then I'll show you the example. So my apologies. So everybody asks me, Michelle, how does this work if I actually need it for my care? They can't just, if I had a life insurance policy at 250,000, you can't just call up the company and go, hey, I'm in a nursing home, send me a check for 250 grand. It doesn't work that way. Remember, these bills show up monthly, therefore this pays out monthly. So here's how it works, and I'm going to show you a timeline. So here I have my life insurance policy, and that's just this dark blue bar. And to the left is day one, and we're going to move out to the right over a period of time. So it's, in my example, I just used 250,000. It's still a finite bucket. Shawn, it's more than what I had, but I could still burn through that pretty easily, and it's tax free. So I like that too. But it's just using whole life insurance, and whole life insurance has been around for quite some time, and it is solid because it always does exactly what it says it's going to do. There's no surprises in this, nor do you want surprises, especially as we get older. We don't want the surprises. So we pay out 100% of these policies, and I'll tell you why. You either quit, you live, or you die. You quit the policy, you've got your cash value in it, you can walk away, it's your money. You either don't quit, you live on it for long-term care, and if that's the case, then you live on it for tax-free and you use the death benefit, or you die. There's not another option there, and your family gets it tax-free. So 100% of these get paid out. There's no guesswork here. The real sizzle is the second part, and that's that yellow part. So this is where we make this income payment, this income to pay these care bills forever. And so the yellow part, there's no cash value or death benefit to that. All that it does is it kicks in and it just keeps on making those payments for however long you, or if you're married, you and your spouse live. So if you think about it, and Shawn, this is where I want to ask, make sure that I'm explaining this correctly. So this yellow part is really just that catastrophic major medical type insurance with a high deductible. And I say deductible for a reason because that's how I want people to view it. So really, how do you satisfy a deductible? A deductible, you use your own money. And the higher the deductible, the cheaper, less expensive the catastrophic coverage is. And by the way, it works really, really well. I have a health savings account. It's a $7,000 deductible that I can use a tax-free account to satisfy that deductible before the catastrophic kicks in, but I pay really low premiums for my catastrophic coverage. Same thing with car insurance. If I increase my deductible, I pay less in premiums. Most people understand I have a need for a worst case scenario. I just don't want to pay crazy premiums for it. Shawn, did that make sense?
Yep, makes perfect
Okay,
sense. I think most
excellent.
people have
Good.
some sort of
All right, so
understanding
here,
of deductible.
yes. So here is the first example. Now, this is someone that is in their 60s. They're approaching retirement. I'm going to show you for someone in their 40s here in just a moment. So if this is a person that we asked, how would you pay for it? These folks have already saved up an emergency bucket. And they're already aware that health is going to be a reason. And by the way, if you're a younger person, when I say younger person, 30s, 40s, think about your parents in this situation because they might need to make sure that they have a plan in place as well. So share the information. Sharing is caring. Make sure that they understand that they have options as well. But this couple decided that they were going to reposition this. They just had it at the bank, $150,000 sitting at the bank doing nothing. Bank is paying point squat. So it's just sitting there. And they're going to reposition it. And here's what it gave them. It gave each of them $91,000 a year tax-free to pay for these care bills when they started coming in. So it's $91,000 for him, $91,000 for her. So we asked them, what kind of rate would you have to earn on your $150,000 to generate $91,000 every year for the rest of your life? They would have had to have earned 61% year over year. Don't laugh. I know that sounds funny. We're not paying 61%. What I've just done is I've changed the way that your viewers are viewing insurance. Insurance is just a bucket of income. It's a bucket of income designed to pay a very specific bill, and it's invisible income. Why do I say invisible income? Because this income the government doesn't see as taxable. So this is tax free. Therefore, you don't have a higher tax rate. You don't have higher Medicare premiums. You don't have to pay more in salt, salt tax, state and local taxes, because all of that plan remains intact. We want as much income tax free, invisible income that we can find. And that's what this provides. It's providing it for a specific purpose. Now, if this male and this female, if they never needed care, their family is going to receive $182,000 at their death. It's not a whole bunch more than what they had, but it still passes probate, and it goes straight to the kids immediately. So whether you live on it or you die, we're still protecting the entire portfolio. Shawn, when I show this example, what's the first thing that you think of?
I don't know anywhere else you're getting 61%. I mean, that is some great pennies for
Not
dollars.
guaranteed.
Yeah.
Yes.
Wow. That's incredible.
Yeah. Yeah, you're not getting it tax-free, and it's not guaranteed, and it's not year over year. So that's what we're talking about, is we are creating a consistency. And by the way, these options have been around for over 35 years. People just don't know about them. All right. So let me show you a younger couple. So this is a 49 and a 48-year-old. And so I like to call this the 401k for long-term care. And the reason is because a 401k is something that you might put into, whether you like 401ks or not, we know that they exist. But someone might put annually, into a 401k, and then hopefully later on they've got a larger bucket of money. Now, 401ks might not be the greatest situation because you're inevitably going to pay taxes on that anyway. Like, there's still you have lack of access to it. But I want you to think of it in terms of, we're just going to make payments over a period of time. We're going to make deposits, and then we have a larger amount available to us. So for these folks, they're going to pay $5,600 a year. What is that? $2,800 each? Is that what that is? I don't do math. Yep, $2,800 each. These premiums are rate locked. You never, unlike health insurance, car insurance, or homeowners insurance, you never ever have to worry about these premiums increasing over time. They are guaranteed to stay the same. So it's $5,600 that covers both of them. So think about this. If my company said, Michelle, all you have to do is put in $5,600 a year, every year, just $5,600. And when you retire, you and your spouse are guaranteed $84,000 that you don't have to pay taxes on. Would that be a good deal? Hey, yeah, I'll take that all day long. $84,000 a year for the rest of your life. Oh, and by the way, if you never need it, we're going to pass on to your kids $168,000 tax-free. So this is a very popular option for a lot of people because they can save into it. And remember, the younger you are, the lower the numbers, because you're actually younger and healthier. Now, this is not the option that I chose. I'm going to show you one more option. This is what I did. This is not my numbers, but you'll understand it. I did not buy all of my future needs at one time. As a matter of fact, most of us don't do that throughout life. We buy a little bit here, we do a little bit more, we do a little bit more. We call this stacking. So I bought my first long-term care policy when I was 38. I bought my second one at 44, and I'm about to buy my third one because there's new options available in the state of Indiana, which is where I live. So I'm about to do my third option. And there's a reason for that. I bought a small policy, then I bought another small policy. So over time, I'm kind of dollar cost averaging this. So here's the scenario I want to show you. So this happens to be a male and a female, age 40, and they're going to buy the smallest policy that they can get. The very first policy they can get is going to provide each of them $25,000 a year for life, forever, income tax free. That only costs them combined $1,300. That's like a little over $100 a month. Shawn, I'm pretty sure I spent that on dinner on Saturday night. We went to dinner. It cost $100. So we're talking about dinner out to get this first policy in place. Now, is $2,000 a month enough to pay for nursing home? Heavens no, it's not. But you know what we'll pay for? It'll pay for someone to come in, and when my husband is battling cancer, I can pay for someone to come in 2 times a week and lift him in the shower. I can pay someone to do the heavy lifting in those cases. It buys a lot of time, and it relieves a lot of pressure for me having to find that $2,000 somewhere else. Well, then maybe 5 years later, and it doesn't have to be 5 years, we're just going with 5 years. Let's say my first kid graduates from college. I just got a pay raise because now they're off the dole. So I have more money. I buy a second policy. I do it again when the second kid is out of school. And then right before retirement, I add on a fourth policy. If you aggregate all of this together, here's what I get: $200,000 in total death benefit, long term care of 70, or excuse me, the premium $7,000 a year, and the annual LTC income that I get for myself and my spouse $100,000 a year each, tax free forever. Now, here's the really neat part about this. Let's say my husband passes away in the future and I can't afford this anymore. Well, all I have to do is drop the last one and leave the rest of it intact. Had I just bought one policy, I wouldn't be able to do that because I can't make changes to the one policy. But I can drop off the last one. It offers me flexibility, which everybody needs in their life because you don't know what's going to happen. So it offers the different things. Here's the other thing: what if at age 49 I get diagnosed with MS? MS, you can't get qualified for long term care insurance anymore. Don't you think I'm glad that I got the first two policies in place? Yeah, I got something. And again, $4,000 a month relieves a lot of pressure off of my husband finding that $4,000. Maybe the nursing home is $7,000 a month and he only has to come up with three, but we've got four somewhere else. Again, it buys time and it relieves a lot of pressure. Shawn, what do you think about this option?
I absolutely love the idea of stacking. This seems like such a great move for people who are like most people. As you progress through your life, you start making more and more money. That's the hope, the expectation. So this is kind of growing with you. But like you said, the idea is not to buy everything all at once. The idea is to kind of stack these over the years as your budget sees fit. But what's so awesome is, one, this amount is covering two people, which is
Yes.
crazy. It's fantastic. But two, like you said, it doesn't have to be something that covers the entire amount. If you're doing 2,000 a month that you're getting, or 4,000 a month, that is a big help on the rest of the expense that you might have to come out of pocket for. If I told you I'll give you 2 or 4,000 to help supplement that, would you say no, I'd rather pay the 7 myself? No, you would take the money. So
That's right.
this is such a cool idea. This is what we're doing with my wife now that she's 35 years old. And as soon as I turn 35, we'll hop on a partnership policy and then just kind of stack them from there as life goes. And we start to continue to increase our income up to the point that we see fit.
Yeah, thank you for giving that extra commentary because you're right. We're seeing a lot more people get involved, and mainly because we've got, when I say younger people, again, people in their 30s and 40s, watching their parents start to struggle with this. And they may have watched their parents take care of their parents. So they're very aware. There are more people discussing this, but the options that I just showed you are just a couple. There are so many options. So here's what I'm going to leave you with: you are only one choice away from changing your life and for those that you love. Again, there's a trajectory that we're all on, and we can make decisions to either go in one way or go the other way. And I had a childhood pastor one time says, you can't open a book, read it, shut it, and pretend like you didn't read what you just read. So now you're aware of it. So now you're going to make a conscious decision to either start to explore these, look into it. It doesn't mean you have to do it right now, but now you're aware that there's a problem and there are options out there. And there's a lot of options. There's even qualified money options, IRA options that people might choose to use. There's a lot of different planning strategies out there. But I want you to know, it doesn't have to be a one size fits all. It doesn't have to be, I'm going to just plan for government assistance. I'm just going to, plan for it to pay for it out of pocket. There are so many things that you could do, but I just encourage everybody to constantly be learning and educating themselves because there's a lot of really neat things out there and tax incentives that most people aren't aware of. So, Shawn, first and foremost, thank you so much. Again, I said it at the beginning, you're advocating for the people that you serve and you're bringing them quality information and education that other people aren't bringing them. So I applaud you and I thank you for allowing me to teach today. So thank you.
Definitely. I really appreciate you coming on and spending this time and sharing this information. One point that really stuck out to me that that we had previously talked about that you had mentioned was 70% is a really high number for individuals. But I remember when you said that if it's couples, you're talking about what, 90%, right?
91%. You're right. There's a 91% chance that one of the two of you will need care. Yeah.
91% is
I think there
100.
was a Pretty much. There was a 90% chance it was gonna rain today in here in Indiana, so we are preparing. It's going to rain. Like, we brought in some stuff from outside. It's going to rain. It's happening. Yes.
It's raining here right now, but again, I just thought those were insane numbers. So at the end of the day, the whole idea, guys, is the reason that you're tuning into this stuff and trying to educate yourself and learning is because you want to do what is absolutely best for yourself, your family, and prepare yourself to leave the type of legacy that you want to leave. It's really hard to do that. I'm not saying that you can't leave a legacy of education, which we definitely want, good values, education around money and these type of things, but you would also probably like to leave a little bit of money to leave your family in a better place than you were left when you were coming up. So this is one of those fantastic things that it might not be the sexiest thing when you're talking about it. We're not talking about investing and doing all this other stuff, but the return on your money that's going to protect you and your money in the future is second to none. I mean, nowhere out in the world are you going to find 60, 50, 60% returns on the cash that you put into something. So I I can't even begin to express how valuable this is, how few people are talking about it, and specifically the fact that One America has the best product on the market for this. Really quickly, Michelle, before I let you go, can you explain the difference between kind of what One America is doing with their style of product and long-term care that everybody else, you kind of touched on it a little bit, but that everybody else might be kind of familiar with?
Yeah, well, I'll tell you, a lot of it stems from we've been doing it for so long, so we've kind of got this kind of secret sauce thing going. A lot of companies are starting to join in, but they're not sure of what's going on, so they're going to limit their benefits. Where we've really focused our time is making sure that we have unlimited benefits and flexible options and funding. We used to have a patent on the joint policy. There's other companies that have now offered where they have two people on one policy, but what you'll find is a lot of other companies aren't as well rounded just because they don't have time in the seat. We've really started to focus more on the caregiver. So we have a lot of options because here's what's going to happen, Shawn. When you need care, you're probably not going to be the one calling us. It's probably going to be your kids. Your kids are going to call us up and they're going to have no idea what to do or where to go or what mom and dad bought. And so we actually handhold them through the entire process. You don't typically see that with other companies. They might outsource their claims to a third party company that they just kind of handle paperwork. We've also started to do caregive coaching. So, Shawn, if your wife is going to help take care of you, she doesn't know what to do. So we have home health aides that will coach them through the entire process so that they're not left alone. How do they take care of themselves and make sure that they stay sane through this entire caregiving process, but also how to pick you up properly? Maybe there's a certain way to roll you in order to lift you versus just trying to lift and then throwing out your back. So we are trying really to take care of the families because those are going to be the ones that are most impacted when someone needs care. So we've really tried to create the entire experience from the beginning all the way through to the end.
That's awesome, and to bring you guys a lot of confidence knowing that you're working with a company that's leading the pack, that's thinking about this from both angles, and, yeah, again, such fantastic value. If you guys are interested in getting more information about this, feel free to reach out to me specifically. We have people within our team that kind of focus on the long-term care side of things. You kinda just wanna see some numbers. We have the ability to punch in some numbers. Of course, this is because it is a life insurance product. There will be underwriting that you have to go through, just like you would for your normal whole life insurance policy. So that's, of course, you got to qualify for it. We all kind of knew that. But if you kind of want to see some numbers, get an idea of what you might be paying on a monthly basis, or if you want to pay just one chunk because you got the money, reach out. We can run some numbers for you. Single, couples, as long as you're 35 years old, this is for you. So again, Michelle, thank you so much for the time, and look forward to helping a lot of people and getting them protected.
Yeah.
Awesome.
Thanks, Shawn.
Have a good one. Bye.